Welcome to the Titans of Industry show, and I'm very excited to have a first-time guest on. Very popular guy featured on Zero Hedge all the time, and I really wanted to get his thoughts on what's going on, especially after this massive rally in January. So I'd like to introduce everyone to Lance Robertson. Lance, for people who haven't checked out your work thus far, tell us a little bit about who you are and what hats you're wearing and your capacity for RIA and real investment advice, etc.
Wow, I wear a lot of hats. Yes, my name is Lance Roberts. I'm the Chief Investment Strategist and Economist for RIA Advisors. RIAadvisors.com is our corporate website. We manage money for individuals, retirees, 401k plans, pensions, those type of things. My job is solely to do the portfolio management side of the business. Real Investment Advice is our free site where basically we write a lot about our views. We want to publish, and we use publishing of our views as a method to keep us focused on what we're doing in terms of money management. Writing, and I encourage this for anybody that invests money. If you're investing your own money, I encourage you to write a diary. Just jot thoughts down. What it does is it makes you focus on what's important about managing money, but then it also holds you accountable for those views. And that's why we write these views internally. We publish them because it requires us to be held accountable to those views.
Well, I think that's a very smart idea. I want to start off with a curveball. Is managed money a legitimate industry? Or, I've read so many books, including one from Tony Robbins, Money Masters Master the Game, and it's all about the fact that just going on the index, just staying long-term on the S&P 500 beats, roughly 90% of managed money, and over the years, right? Not every single year. Talk a little bit about this. How can part-time investors be best served? Should they put their money in managed accounts? Should they just let it ride with the corporate America and let just the Swiss clock that keeps on growing just do its bidding? Or should there be a mix or a combination? Just you're in this industry. You're obviously seeing what's going on out of the industry. This industry is changing, adding robots, computers, everything. Just your floor.
Sure, no problem. Ray Dalio once said that, if you want to compete against me, Ray Dalio runs the largest hedge fund in the world, about $160 billion. He says, if you want to invest in the market, you are investing against me. I spend $100 million a year on research. I have 1,500 PhDs, literally rocket scientists, that are doing the analysis, crunching the numbers, doing the research to make sure that we invest money for a profitable return. If you think you can beat me, try. And that's and he's right about that. Let's talk about Tony Robbins and a lot of these views very quickly. It's a great point. The average investor today, most people investing have never seen a bear market. If you think about the number of millennials, a lot of millennials came of age at the 18, right as Obama was getting elected as president. They saw what happened to their parents during the last bear market, but they weren't involved with the actual investing aspect of it. They just saw what happened with the housing and the markets, et cetera, and they became the age of 18. And all they've seen over the last decade is this ripping bull market that's been, underpinned by massive amounts of liquidity from the Federal Reserve, et cetera. So it's certainly understandable that you have a lot of this rallying cry that you should just buy the index and go up. It's a myth that indexing outperforms active managers over the long term. You can go back and look at any of these long-term mutual funds, American funds, America Fund, right? Fund of America. You take a look at a lot of these funds that have been around since the 80s or 90s. Compare them to the S&P. They've outperformed them over the long term. Yes, from one year to the next, they will certainly underperform on an active management basis. But over the long term, good active managers that preserve capital during downturns will outperform a buy and hold index over time. But there's one more aspect to this. Let's just assume that you do buy off on this idea you should just invest in the index. And yes, I absolutely agree that over a 30-year period, the markets will be higher than they are today simply because of growth and inflation. And so, yes, you will increase value. And the myth that's put out into the marketplace, we wrote a series of articles about this, is that if I make $40,000, the average income of the average American family, right? I make 40,000 or 50,000, or let's move it up. Let's say I make 70,000 a year. I'm making good money, so I'm going to save money and I'm going to put it into the S&P 500 every year. I'm just going to buy and hold it, and I'm just going to dump it in. And over the course of 30 years, when I'm ready to retire, I'm going to have $1.5 million. And so if I take 3% of 1.5 million, hey, I'm making, close to $70,000 a year. And this is what's told individuals, is that if you do that, you're going to be retire wealthy. Here's the problem. While they talk about the growth of the money over time, they don't talk about the inflation adjustment to your income. A $70,000 a year income today is $135,000 in income 30 years from now, just because of inflation. So it no longer requires just 1.5 million to retire buying and holding the index. It's going to require over $4.5 million to meet the same income need. And this is what Susie Orman was talking about recently, this whole financial independence, retire early nonsense. It doesn't work. The math simply doesn't work if you include the adjustments for inflation over time. Here's the simple reality of this. Riding the markets up and down. If I spend 10 years getting back to even, by the way, the average investor that had money invested in 2000 didn't get back to even until 2013. 13 years later, they got back to even. That means 13 years of their 30 years to save for retirement has gone away. Now they've only got half that time to get to retirement. Getting back to even is not the same thing as making money. So active management, preserving capital during downturns, doesn't require you to beat the market every year on the upside. All you have to do is preserve the capital during the downturns. You can underperform the index by 50% on the upside and still beat the index over time if you avoid the losses. That's the lesson to learn.
Well, Lance, I really I love those points, and I'll tell you what. The best book I've ever read about investing is from Howard Marks, and it was the most important. And this guy, he's 1.5 billion net worth, and the one thing he talks about is, hey, my hedge fund is geared to make mediocre returns on the upside and phenomenal returns when everybody else is crashing. That's how I beat. And so it resonates with me a whole lot what you're saying, and it's key for people to understand that a bear market strategy is more critical to your psyche and obviously to your finances, especially if you're looking to retire and bear market hits your account right when you need to retire, right? Which is often the case. Now, the second thing you said, inflation, so true. People don't account for inflation, and obviously this is playing right into the wages situation in the U.S. Real wages are just not going anywhere for decades, shrinking. So that secondary engine of investing has become a whole lot more important. But for people who just said, okay, let me not do the markets. I just want to save, and the central banks have just decimated the saving economy, especially for you obviously run retirement accounts, so you know that as well as anybody else. Why is America running on such low debts? And let me make it a follow-up question for you. If everybody already knows that if you raise rates on America, that they're no good to pay their debts, why isn't it starting to get priced in much more in the markets? Why has the dollar been the best performing asset of 2018? How is that possible?
Well, all right. So a couple of those are two very broad questions. So let's talk about some of the important things here. And this kind of goes along with the previous comment about bear markets. If investing in the markets was so easy, it's just simply buy and hold investing, right? Just buy indexes. Then why is it that 90% of Americans have to come up with some form of credit to meet a $500 emergency? If investing was as easy as it was said to be, if it was simply just buy and hold and dollar cost average, if that worked, why isn't the majority of America wealthy? Why is it just the 1% of the wealthy? And yeah, we all point at the top end of the ladder and say, oh, those bad guys, they have all the money. But if investing worked as if it's told by Wall Street, everybody should be wealthy, but they're not. And this has a function to do with two things. One is that we don't teach financial education to the majority of Americans. Most of the people listening to your podcast have an interest in investing or money, and probably a lot of them listening to you won't agree with what I'm saying. about avoiding bear markets and these type of things. Maybe they will, but at least they have an interest. They have a vested interest, but that's a very small percentage of the overall economy. The average American can't pass a basic financial question of what is a savings account? What's a 401k plan? Take a look at the average contribution to 401k plans. It's often talked about the fact that that all Americans contribute to their plans. Actually, it's not true. Only 50% of Americans have access to a 401k. 50% of the people actually only 50% of people actually contribute to the 401k, which means that 25% of the people in the country are actually contributing to a 401k plan, and the average balance is less than $50,000. That means that most people haven't even saved up 1 year of retirement in their savings account. Why? Because we have an immediate need for gratification. This is why the average household debt's running 140% of debt to DPI, disposable personal income. This is why small interest rate changes, like we saw just recently. The Fed goes from 0 to 2%. The housing market craters. Auto sales decline sharply. Delinquencies on credit cards pick up because people are running such a close balance to basically living paycheck to paycheck that even small, minute changes in the required payment structure devastates household balance sheets. So why is the dollar performing as strongly as it is? Because the rest of the world is worse off than the United States. So capital is coming here from foreign countries looking for a higher yield on treasuries. Treasury rates went up to over 3%. The interest rate in the rest of the global economy on the mature side, people, places where you'd actually want to buy debt, not Venezuela, have lower yields than the U.S. So money was being attracted into the U.S. And of course, if you live in any other major country and you need to store excess reserves, economic growth is weakening everywhere else in the world. So if I've got excess reserves as a country, where am I going to store them? In Russia, China, Venezuela? No, I'm going to store them in the U.S. All of that drives the dollar to be a stronger currency relative to the rest of the currencies of the world, but it doesn't change the balance of what's happening to the economy across the broad economic spectrum.
Now, Lance, I want to ask you, when you invest in companies, in American companies now, because of what you're saying, because of the consumer debt, do you look for companies that have exposure not to the domestic industries, but to international emerging markets, China, whatever? Is this something you are looking at? Because I'll give you an example. Starbucks, a very iconic American brand, right? They're building a new branch in China every 15 hours. So, if you think about a company like that, that's a company that is a U.S. company, headquartered in the U.S. Everything about it is American. But if you try their non-U.S. branches, you see that they cater to the locals and they do lots of things differently over there. But they're growing internationally. So is that something that you look into going forward? How China and Asia in general, India, etc., Indonesia, that is expected to be a bigger economy than the U.S. in 15 years? So, are you looking at this as well? Is this important to you?
I think you're foolish if you don't. And let me tell you why. 40% of corporate revenue, corporate income, is from international operations, exports, right? So what we export to other countries is 40% of corporate profits. So if you look at what just happened to Apple recently, a big decline in Apple because of concerns over what's happening in China. So yes, if you're not paying attention to what's happening on the global economy as well as what's happening with our exports, then you're missing a big input as to what's happening with corporate profitability. So yeah, when we're buying stocks, we're looking for companies that are trading at a discount to what we feel is a fair valuation for the company. That's a very difficult prospect right now because a lot of companies are trading at extreme premiums, things that shouldn't be trading at levels where they are. So, finding true value in a momentum-driven market, late stages of a bull market cycle, which we are in now, 10 years of a bull market, valuation has become much more stretched. So we're in the momentum phase of a market. So part and parcel of our analysis for buying stocks for portfolio looks at momentum currently because valuation is much more difficult to come by, but it's still a very, very important component. And also looking at the impact of what's happening internationally. In February of 2018, we sold all of our basic material stocks. We sold all of our industrial stocks, all of our emerging markets, all of our industrialized international markets. Why? Because of trade tariffs and trade wars. We said at the time that that was going to be a negative input to those sectors and those earnings, and that's exactly what's been the case. And these policies take time to show up. They don't, just because I announced a tariff today, people said, see, they announced tariffs and nothing happened yet. Well, it takes time for these things to filter through to balance sheets and income statements. But what are we hearing from a lot of companies in the last couple of quarters? Impact of tariffs. What's happening? It's a much more common theme that's coming up inside of earnings reports for companies. So you have to pay attention to what's happening politically, because and I'm not talking about right versus left and all this other stuff. I'm talking about policy, right? So fiscal policy, monetary policy. It's important to the outlook to your portfolio and where you place capital, because these things don't mature overnight. It takes time. It takes 6 to 9 months for a change in fiscal or monetary policy to actually show up, but it will, and it does. And, for instance, tax cuts. We saw tax cuts come in December of 17. Immediately we had this big boost to earnings, and the economy had a big jump in the first 2 quarters. That had nothing to do with tax cuts. The jump in the economy had nothing to do with tax cuts. It was too soon. That hadn't had any impact on the economy at that point. So why did the economy jump? Well, we had 3 major hurricanes and 2 major wildfires in late 2017 that required billions upon billions of dollars of stimulus to build in repairs and operations, etc. That's where your boost in the economy came from. And this is why now we're seeing that reduction in global and economic growth, weakness in the manufacturing sector, et cetera, because that stimulus is now wearing off. So you have to pay attention to these. It does impact the bottom line. But yes, at the end of the day, when you're buying stocks, you better be paying attention to what's happening internationally, paying attention to what's happening with valuations, and paying attention, most importantly, what's happening with free cash flow.
Lance, I want to ask you, Ray Dalio, going back, you started an interview talking about Ray Dalio. He says one thing that keeps me up at night is populism. But then he says, look, if I couple this subject to any other subject, it would be a U.S. dollar bear market that takes it down about 20-25% in the next 5 years in terms of real purchasing power. And he's saying, look, we're running $1 trillion deficits when the economy is good. And then, what I think is important for people to understand about the U.S., it doesn't matter recession or boom, you need to pay all these obligations as long as you don't, cut them or postpone them or anything. It doesn't have anything to do with economic growth or with tax receipts, Social Security, Medicare, Medicaid, etc. And then you got obviously the income security and the defense, education, and the existing interest on the debt. So, if we're moving into a slower economy, and all things looking like we are, the U.S. doesn't live in a vacuum. If the rest of the world is slowing down, it's obviously going to impact the U.S. as well. And then we already saw record stimulus, tax cuts, whatever you can throw at this. The fire is at its peak capacity. So, tie this in there. Is this the start of a bear market for the U.S. dollar? And if so, do you think commodities are a good hedge?
So we're long gold and gold miners in our portfolios right now, specifically for that reason. As Ray Dalio said, and this is something we've talked about a lot, is that we're running $1 trillion deficit in an expansion, which doesn't leave you a lot of flexibility. When we were coming out of 2009, and this is a good example also too recently, the Federal Reserve just said last week that, they're going to be patient on rate hikes and that they will, potentially review or revisit or be flexible in terms of the reduction of their balance sheet. So, this got all the bulls excited, right? It's like more QE, more QE. Well, think about this for a moment. The reason that QE worked, and you go back to 2009, investor confidence was shattered. Everybody was convinced the market was going to zero and the world had ended, financially, and the markets were never going to come back. And you take a look at household assets in terms of equity ownership of households. That was at 40% of DPI versus 110% today. You take a look at any measure, economic growth, any type of structure back in 2009. Everything was blown out. So here we are 10 years later. We've got the balance sheet for the Fed was $915 billion in 2009. It's $4 trillion today. Interest rates in 2009 on the Fed funds rate was 4.2. It went to zero. We're at 2.2 today. So half the rate. Here we are a decade later into this. And of course, we're talking about that every market's due cycle, but they're saying, hey, we can postpone this because the Fed can do QE. The magnitude of QE, it took $4 trillion to move the markets up from where we were in 2009 with a great under exposure to assets. So there's a lot of pent-up demand. We have no pent-up demand today. So to get the same type of bang for your buck, you can only lower interest rates by 2%. It's going to require roughly $16 trillion in QE to get the same net effect out of the market that we got from 2009 to 2018. So the impact of that is ultimately going to show up in inflation. And when inflation shows up, you definitely want to be on the commodity side of the ledger in your portfolio. I'm not saying go out and throw all your money into gold and beanie weenies and buy guns and ammo, but you are going to get an inflationary push at some point from simply a concern by the rest of the world. And again, this is what we're talking about specifically, right? A loss of faith in the U.S. dollar. In other words, I don't want to store my excess reserves in the U.S. because I am concerned about the value of that investment. And if the rest of the world no longer views the dollar as a safe investment and they start shifting that dollar excess reserve somewhere else, you are going to see a decline in the dollar. You are going to see inflation start to really rear its head. And then the place you're going to want to be at that point is in gold or safe haven assets.
Yeah, I think one thing that's important is to notice that you said QE worked, and I assume that you meant it worked for some, or it worked, it worked in its own little awkward way, because obviously it created a huge wealth gap and everything that we have. It had unintended consequences, is what I'm saying. I want to ask you, Lance, in closing, first of all, where can people check out more of your work? And secondly, if you have a very important last thought that you really want to throw at people to make sure that they are focused on something that you say now, and in a few months when we have you back on, you can say, hey, I told you people that this is going to be critical this year, and just let's get some accountability on what's going on, right?
Yeah, so a couple of things here. One, if you want to find out more of what we do, yes, definitely go by our website, realinvestmentadvice.com. We publish blogs there every single day. You can also get in touch with our podcast there as well. We do a morning radio show every day from 6 to 7 a.m. Central Time. And so we talk about the markets on a daily basis as well, where we're positioning, what we're doing. And you can find all that at realinvestmentadvice.com, absolutely free. A parting thought here about what's important for this year. We were blowing out the markets on December the 24th. And, of course, the Fed changed their tune. We had Steve Mnuchin, the U.S. Secretary, come out and say something very unusual for a Treasury Secretary, which is that, hey, I'm calling the banks to ensure them that there's plenty of liquidity. You don't do that unless there's potentially a problem.
It sounds like the audit that he did, like a 5-minute audit to the...
Exactly. And so, he did that. And then he said verbally, he says, then I'm going to get with the president's working group. Of course, the president's working group is the very, known plunge protection team. This is the group of people that are involved with making sure markets function properly. And so, they make very public statements. We get this big rally off the lows on December 25th. And again, and I'm actually writing an article today saying, hey, on December 25th, I wrote an article that said it's now or never for the bulls and said that this is the bottom near term. And so we've had this big rally. Here's the outlook for this year. A lot of people are very convinced that the bear market is over. You very rarely have the type of financial destruction that we saw in October, November of last year and December without a retest of those lows. And I think as a good comparative example, go back and look at late 2015, early 2016 as an example of what we're talking about here. I think this year there will be a very high probability of a retest of lows at some point. Now, it doesn't mean we can't finish this year right where we are now or even higher, but there's a real possibility for markets to retest lows. So this isn't necessarily time now after this rally. We've gone from extremely oversold to extremely overbought in a month. This isn't the time to become exceptionally bullish on the markets. We need to see what happens during this next retest. If markets are able to hold lows, if markets are able to hold supports, then maybe we put a temporary bottom into this market. I think that a bigger decline is coming. I don't know when. Nobody does. Nobody can predict, that far into the future. But a retest of lows is almost assured at some point. And if we do break those lows, we will be moving into a much broader bear market correction later this year or in 2020. The place you want to be most likely is in U.S. Treasuries and gold when that occurs. So again, when we come back in a few months, it's probably going to be too soon. We probably won't be in that phase yet. But I think by the end of this year, I think we're going to see a bit more turmoil. In other words, our friend of volatility has returned in 2019.
Very interesting, Lance. We'll definitely have you on again, like I said, in a couple of months. Very exciting research that you guys do, and I really like your work, your charts, everything like that, very, very interesting fellow. Make sure you research realinvestmentadvice.com, and we'll see everybody soon in the next interview. Thanks, Lance.
Thank you.